News Talk 94.5 WPTI, 96.7 FM WTOB. And you're listening to the Wealth Guardian Show with Doug Ray, helping you to retire that job, but keep your paycheck. I'm your host, Doug Ray, and with me is Mr. Brice Payne. Morning, Brice. How you doing?
I'm a little on the warm side, Doug. I'm ready for a little bit of a break here in the heat. How about you?
Oh, I tell you, I'm looking forward to fall and football.
What's that? Only about 5 weeks away now?
I'm tired of the soccer stuff.
Yeah. It is interesting. I played soccer many, many years ago, but I've never been a fan of watching it too much, oddly enough. But I think we're doing a good job of hosting it at least.
You know, I was learning hockey with my younger son is an avid Hurricanes fan. So I was learning hockey as they went through the playoffs. Right. So I tried to watch the U.S. and Belgium and take those same hockey rules and apply it to the soccer.
Oh.
No. It doesn't work.
There's no icing.
Doesn't
grassing,
work.
Whatever it might be. Yeah.
Right.
All right. Well, thank you, everybody, for joining us. We're glad you could share a little bit of your weekend with us here this morning. Wealth Guardians radio show. You maybe listened to us before. What we are is holistic financial planners here in the Triad area with about 500 clients. And what we do every weekend morning is just take a few minutes and share with you some topics around retirement financial planning. And so hopefully you'll learn something by the end of this. Hopefully it won't be too painful for you. And Doug, why don't you lead us off by the Wealth Guardian Service Salute, if you would, please, sir.
Amen. Yes, we always like to say thank you for all the sacrifices that our service members are making, our first responders, our veterans, and especially keeping in prayer our service members who are in harm's way over in Iran right now. Thank you so much, and thank your families because you sacrifice too. It's a tough job being a family member of a service worker. Thank you so much.
Indeed it is, and now we'll double that over here. Thank you very much. All right, Doug, well, what do we do at the beginning of each show before we get into the meat and potatoes of the topic is we ask ourselves a question, better get to know your Wealth Guardians financial planner. I thought I'd make it easy this time and just ask, Doug, what was you went to East Carolina. Mm-hmm. What was your first choice? If you didn't go to East Carolina, where would you have gone if anyone out there would have taken you?
So my plan A was to play ball at Notre Dame.
Football.
Mm-hmm. And then later for the Packers, because, I'm an avid Packer fan.
Indeed.
Well, that goal lasted through about my sophomore year in high school. I was a pretty decent football player, but not Notre Dame standards.
Pretty big guys there.
Not even close to it. So it was off to plan B, C, and D.
Okay. Well, you're not Catholic, though.
No, I'm not. I'm Anglican.
I mean, you don't have to be, but that's Notre Dame. Just curious there. All right. Well, if you ask me the same question, I was coming out of high school. I was pretty infatuated with all things California at the time, and I wanted to go to Pepperdine more than anything else. I don't know if you've ever seen the Pepperdine campus, but man, oh man, where they are located at the top of the hill, looking out over the ocean there.
Stanford's got a beautiful campus,
supreme property, and I wasn't even close to qualifying for that because, of course, everyone in California wants to go there as well.
Sure.
And so I ended up going to University of Colorado, my home state college. But that was my first choice.
Not a bad choice.
And then I wanted to, after graduating from Pepperdine, I wanted to be a professional surfer. And I maybe was able to stand up on a board a couple of times.
Ask Garrett about surfing.
Yeah, he does.
He's pretty good at it.
Garrett does surf for what you get in North Carolina waves. They're not you don't see too many professional competitions out here in the North Carolina coastline. But I see him have the surfboard in the back of the Jeep. So I guess he just keeps that in there for whenever he can get out to the coast still.
Yeah, we were on vacation a couple of weeks ago, and we actually had some decent waves down at Oak Island, and he was teaching his son, my grandson, who's 10 years old, his first surfing lesson.
Oh, was he really?
It was kind of fun.
Oh, there you go. All right.
Yeah.
Very good. All right. Well, Doug, what we're talking about here today is learning through uncommon sense. So at first glance, each of these statements that we'll be going over seems like basic common sense that everyone agrees with. But when we look at the way people actually behave with their money, it seems that common sense is actually, maybe unfortunately, a bit on the uncommon side. So the first phrase that we'll go over here is buy low and sell high. And Doug, this is probably one of the more common or famous phrases or sayings out there when it comes to the financial planning or the investment world. Of course, buy low, sell high means that when you're investing, you buy at a low price and sell at a high price rather than the opposite. What are your thoughts on that statement, Doug?
Isn't it absolutely logical?
Well, yeah.
Well, why doesn't everybody do it? You know, I've been in this business, 30, too many years to count now. I have always been amazed at the retail investor.
Yeah.
Because inevitably, if they don't have guidance, they always buy high and sell low. The reason is pure driven by emotion.
Yeah.
Recent example, remember last month, SpaceX, biggest IPO in history.
Right.
Okay? We had clients calling in left and right, wanting to buy SpaceX.
At the IPO, yeah.
At the IPO, which we couldn't get them IPO shares.
Yeah.
IPO'd at, 139-ish, I think, something like that. Okay. And, we told them, we said, wait, look, everybody who got the stock, like Elon and all of his employees, there's this thing called a lockup period. Mm-hmm. It's 6 months long. We tell our clients, wait till December. You're going to get the stock at a lot lower prices. Buy low, sell high.
Right.
But no, what did they do? They went in and they jumped on the stock the day after, 2 days after. Some of them bought it $190, $200 at the absolute high.
That's the worst time to buy it.
Absolutely.
A couple of days after the IPO, that's where all the people are trying to make the quick buck or selling.
Now, if they hold it, I think they're going to do well 2, 3, 4, 5 years down the road.
Oh, yeah.
But right now, I think that I'm going to, full disclosure, I plan on buying SpaceX stock for my own account, but not now. I think it's going to be cheaper in December.
Right. And you've been an avid investor for 40 years?
Quite a while. Yeah.
Very good. What I see, Doug, you asked the question, why do people do it like that? Excuse me. I would say because somebody who's a novice investor out there, the amateur investor, let's say that they've got their eye on a particular stock. They want to make sure that it's going to go up. So they watch it and they watch it and they watch it. And it keeps going up and keeps going up and keeps going up.
Yeah.
Now they feel confident that it's going to continue to go up. So then they buy into it. Well, at the same time that the novice investor has figured that out, that, okay, now it's had a long enough track record to go up that I'm going to jump in. The expert investors are keeping an eye out for the odd lots. Mm-hmm. Of when the amateur investors are buying in, so they now know, all right, now it's time to sell.
Yep.
And they sell when it's high.
Yep.
And they're the ones. I'm going to use another example here in a few minutes on another one of these. But that's my theory as to why people buy low and sell high.
Well, it's the old FOMO, fear of missing out too. And you're exactly right. Institutions will sell their shares to the retail investor as it comes down. Absolutely.
Yeah. All right, so that's the first one. And if you're just tuning in, you're listening to the Wealth Guardian Show with Doug Ray. And in this first segment, we're going to talk about it in the second segment as well, is learning through uncommon sense, some common phrases or statements out there in the financial planning world. And Doug, the next one here is don't pay more in taxes than you have to. One of the main things that we do here at the Wealth Guardians that we help our clients with, of course, is portfolio allocation. We put on the investment advisor hat, but that's one of the many hats that we wear as financial planners. But the other main hat that we wear is a tax mitigation hat. We help our clients make sure that they're not giving Uncle Sam a tip unnecessarily. And there's a lot of ways that you can structure your accounts or create distribution strategies year in and year out that'll have you not accidentally jump up into a higher tax bracket, or some things that you can do to actually lower your tax bracket from what you would have done if you just handled things, quote unquote, normally. And so don't pay more taxes than you have to. Nobody voluntarily signs up to pay the extra taxes. Doug, I am glad that we help our clients with tax mitigation, because what is that phrase that we have? Investing is opinion and taxes are fact.
Right.
What does that mean?
Everybody hates paying taxes. I hate paying taxes. You hate paying taxes, especially, what we've seen in the last several months about how it's just squandered at the federal level. So much fraud and everything going on. Our tax money is just wasted.
Yeah.
But at the same time, people, I think, take it to too high of a degree of hating to pay taxes. remember something. If you bought low and sold high, you made a profit. You're paying tax on that profit. But by goodness, you made money. Be thankful for that.
Yes.
And remember, long-term capital gains tax rates are lower than your income tax rate anyway. So, you can take hating paying taxes to an extreme is what I'm saying. But yeah, we do everything we can in order to limit a client's tax liability. We even have an equity model that does that.
A couple of equity models. We do. Yeah, conservative ones, moderate ones, and aggressive ones. That statement that I said earlier, Doug, investments are opinion and taxes are fact. If somebody out there didn't understand that, what that means is you could go to 10 different investment advisors and ask them, what is the most sensible portfolio for me for the next 2 years? You would get 10 different answers that probably aren't coming close to resembling each other. But if you went to 10 CPAs or tax attorneys and asked them, what should I do with my accounts over the next 10 years to pay as little in taxes as I can, you would get more or less very similar answers from all 10 of them, because there's an actual strategy behind that you can't argue with. It's fact. It's on paper. Here are the tax laws. Investment strategy, yeah, that's opinion. You're gonna have 10 different people tell you 10 different things, and there's never a definitive right way or wrong way until we can look back after the fact.
Exactly.
All right, so that's buying low and sell high. Doug, we've got to get to our break here, so let's go ahead and do the trivia question, and then we'll get to the remainder of these three, learning through uncommon sense, on the other side of the break. Are you ready for the trivia question? Doug always says no and laughs. Doug, are you ready for the trivia?
I'm ready. Go ahead. Give it to me.
Here we go. What U.S. state produces the most peaches? Easy and simple. What U.S. state produces the most peaches out there? I'll give you a hint. It might not be the state or states that you think. All right, well, stick around for the answer to that trivia question on the other side of this quick break. See if we stumped Doug. This is Brice Payne. With me is Doug Ray. The show's The Wealth Guardians, helping you retire the job and keep the paycheck. And this is Newstalk 94.5 WPTI. And this is 96.7 FM WTOB. Newstalk 94.5 WPTI. 96.7 FM, WTOB. Welcome back to the Wealth Guardian Show, where we help you retire the job and keep the paycheck. I'm Brice Payne in the Wealth Guardian studio, along with Doug Ray. And in this segment, we're going to continue our discussion on learning through uncommon sense. And I want to ask you this. We've asked the trivia question, but let me ask you this first. Are you planning to retire in the next 10 years or so? Okay. Have you met with a retirement income certified professional who's also a fiduciary? If you have not, let me here officially invite you to take us up on a complimentary review of your current situation. As certified retirement planning specialists, we'll put together a customized written plan with strategies for portfolio allocation, income distribution, Social Security filing, and tax efficiency, with the additional benefit of often reducing both the risk and fees of your current plan. So if you put aside at least $400,000 and you want to take us up on this no-cost, no-obligation review, give us a call, 336-391-3409, or go to thewealthguardians.com. That's thewealthguardians.com to learn more. Let us show you in black and white how to retire the job and keep the paycheck. Okay, let's go ahead and get to that trivia question. Doug, the question was, what U.S. state produces the most peaches? And I warned everybody out there, it might not be the answer that you think. In fact, it might not even be the answers that you think. Doug?
Yeah, it's interesting. I actually kind of saw a news segment about this just this weekend. And you're right. It's not the state you would think of. It's not Georgia, the peach state, right?
That's correct. It is not Georgia, so good job so far.
And, of course, South Carolina is always known for their peaches.
That is true.
But I didn't listen to the whole segment, but I think what they were getting at in that segment, I think it's North Carolina.
Oh, you were so close. You were on the right track, Doug. Right. You are absolutely correct. It is not Georgia. Everyone thinks it might be Georgia because it's the peach state, right? 30 to 40 tons a year of peaches Georgia produces. Well, then those who are kind of familiar with the Southeast might say, nope, I know it's not Georgia. It's South Carolina. Well, if you said South Carolina, that's what I thought going into this, and I should have known better. South Carolina produces 70 to 90 tons of peaches. But you know what, Doug? There's another state out there that has 5 times the population of Georgia and South Carolina, that is also peach producing weather. What state would that be?
I'm only guessing Virginia.
California.
Really? California?
California.
Okay.
520 tons of peaches.
Wow.
A year. So it's not even close. So why Georgia is the peach state when they come in third, that's a mystery for the ages. We'll tackle that on some radio show on another day. Why is South Carolina the peach state?
Let me tell you what I did learn about on that news clip about North Carolina peaches in particular this season. Supposedly because of the drought, it made them super sweet. So they're some of the best tasting peaches.
Really?
That's what they're saying.
Okay.
I haven't had one yet, but I plan to.
All right, I'll go out there and grab some of that. Thanks for the tip, the investment tip there, Doug. Invest in
peaches.
North Carolina peaches right now. Droughts, we should have droughts more often, right? All right, well, we went through buy low and sell high in the first segment. We talked about don't pay more in taxes than you have to and how the Wealth Guardians help our clients not just with portfolio allocation, but also with tax mitigation. The next one is keep costs low. Now, Doug, when we sit down with somebody who wants to go through the financial planning process with us here at the Wealth Guardians, and we go over their expenses and their investments and their income and help them put together a distribution strategy and a portfolio strategy, when we get to when we're going over, hey, what's your income look like? People know that. They know what their income is. Now, of course, we talk about what your pensions might be in the future, what your Social Security is going to look like in the future. But people come to us, they generally have a pretty good idea of that. They like to have an idea of how much they're either making now or going to be making in the future. No surprises there. When we ask them about their assets, what they've already accumulated, people generally have a pretty good idea of that. They get their statements, they log into their accounts. They like to know if they're sitting at $1 million or $2 million or $5 million, whatever it might be. But when we ask them, what are your expenses? How much do you spend in an average month? When you retire, and maybe the mortgage is paid off or the kids are out of college, what is your monthly expense going to be then? That's when people don't know how to answer the question. They've never gone through that exercise. So when we say keep costs low, we're not talking just about expenses. That's one thing. But the other thing that we talk about in that is what are they paying on their portfolio? What is their total expenses on their portfolio? And I can ask you out there, if you're listening, do you know what your total portfolio costs you on a monthly or an annual basis, quarterly or annual basis? Doug, what are your thoughts on that?
I'll tell you right now, 90+% of folks out there have no idea what they're paying.
That is true.
They think it's 1%. That's
the advisor fee. Yeah, that might be the advisor.
You know, there's two major things that we do for our clients when we design a retirement portfolio. Keeping expenses low is one. The other one is having some sort of a stop loss built in so that they don't lose 50% of their money like 2008.
Right. Defensive strategy.
If you can keep your costs low, that means in order to offset inflation, you don't have to go as far out on the risk spectrum.
Correct.
To get that return that's going to offset inflation. So why don't you understand? Why don't you know what your costs are? It's because you can't see them. There's a lot of hidden expenses, especially if you're running a mutual fund portfolio. And for you folks in 401ks, that's about all you have to invest in is mutual funds, unless it's a company stock. So we have software that can actually dig in and it can x-ray your portfolio and it can ferret out all those hidden fees that those mutual funds are costing you. If you're running a portfolio that just has stocks, ETFs, and bonds
directly,
your hidden costs are next to nothing because they don't have those.
Yeah.
ETFs have a little bit, a very little bit.
Yeah.
But mutual funds, even some of the low-cost providers out there have these hidden fees.
Right.
Our goal for every single person that walks in our door is we try to lower their costs in half. And we show you right up on the big screen what your fees are and what our fees are going to be. We compare them side by side. It's absolute transparency. you'll walk out of here knowing exactly what you're going to pay us.
That's exactly right. So usually when somebody goes through the planning process with us and they want us to see if we can help them better plan for retirement, that's usually a 4-meeting process. The first meeting is when we are accumulating all the information from them that we need to perform our fiduciary obligations. They ask all the questions they want to of us. In the second meeting, one of the things that we go over is what the fees are looking like in their current portfolio. Like you said, Doug, we've got the software that can analyze that, helps us figure out what the hidden fees are, what the expense ratio is on the mutual funds, if they happen to be in mutual funds, and most people, unfortunately, are in mutual funds. We're not big fans of those because they are expensive. And we can help our clients figure out in that third meeting how much lower, based on whatever our recommendations are for portfolio allocation, how much lower their fees. And that's not 100% of the time, but I would honestly say, Doug, it's 95% of the time that we lower somebody's fees from what they were paying before they came to us. Now, once in a while, I just had one last week where we actually had to raise the fee on what they were doing by about 20 basis points. But that's not very much, but 95% of the other times, we are lowering their fees. So keeping costs low when it comes to the cost of your portfolio is huge. It's just like paying Uncle Sam unnecessarily. If you're paying fees unnecessarily, man, you want to be able to turn that around if you can. That's what we help our clients do. If you're just tuning in, you're listening to the Wealth Guardian Show with Doug Ray. I'm Brice Payne. In this second segment, we're continuing our discussion on learning through uncommon sense. We're just taking common phrases out there and talking about the meaning of them, phrases that are common in the investment or financial planning world. And Doug, the next one is don't put all your eggs in one basket. I think people can kind of understand that. What does that mean, Doug? Don't put all your eggs in one basket.
It's diversification, and I think everybody understands that. You want to diversify amongst different stocks, different industries, that kind of thing. Doesn't mean you have to have 20 different accounts. Like Garrett had a client come in last year that had 22 different left behind 401ks or something like that. But with the time remaining, Brice, I want to jump into this next topic. Okay. Market timing is virtually impossible.
Okay, going to jump ahead.
People hear that all the time. And the reason I want to jump in on that is because I just mentioned about how we build portfolios and have those stop-loss features in it.
Yes.
I hate this term market timing. It's not market timing. If you understand the market,
it's market understanding.
And you look at the cycle, the market cycle in and out, and it's no different than if you're at the beach and you watch the waves. Waves come in different sets.
There you go.
So does the market. So if you can study the market and you can determine when the market's at a high and it's about to turn and go lower, and there's tools to do that.
Yeah, you're a market analyst.
And there's stochastics, there's RSI, there's MACD, all these tools we use to determine that. It's not market timing, but it is understanding the markets and knowing when to get in and get out. Remember our first topic? Buy low, sell high.
Right.
This is exactly what helps you do that.
And we were talking about Garrett surfing earlier, and one of the things, if you're out in California or wherever, what you'll see is a bunch of surfers sitting above the ocean watching it for 20 minutes or so before they go out there. And what are they doing? They're understanding the wave patterns out there so that when they get out there, they know where to sit and they know how many waves are going to come in before there's that big wave and where that big wave is breaking. And that's just, if you're a good investor, you're going to sit there and watch the market for a while and understand what it's doing, or use the tools that you were talking about and look back and understand, well, what was the market doing a year ago, 2 years ago? Okay, then we have a better understanding. You're not just, when you say market timing, Doug, you're exactly right. That gives it the idea like you're just taking a dart and throwing it blindly at a dartboard. No, but what you're doing is you're understanding the patterns that are in the market and using that to your advantage, as opposed to somebody who just goes out there and says, now I think the time is right.
And Brice, let me give folks a homework item here.
All right.
If you want to try to understand this stuff, surfers and the market, do a Google search or a Chat GPT, whatever you use for your AI, and search the golden ratio, not the golden rule, the golden ratio. I promise you, you're going to be fascinated at what you find.
You will indeed. All right. Well, unfortunately, Doug, that's all the time that we have this week. Thank you for joining us. And I want to thank everybody else out there for joining us this weekend morning. We hope the rest of your weekend is everything you want it to be. This is Brice Payne along with Doug Ray, the show's The Wealth Guardians, helping you retire the job and keep the paycheck. And I do want to remind you, sound financial plans do not create the themselves. This is News Talk 94.5 WPTI. This is 96.7 FM WTOB.
Hi, it's Garrett Ray with the Wealth Guardians. Thanks so much for listening to the show. Make sure to check out our weekly series, The Vault, on YouTube. Find our channel, The Wealth Guardians, where we talk about all things retirement planning and cover new topics each week, such as Social Security, tax planning in retirement, and our thoughts on investment best practices, and much more. New episodes air Thursdays at 2 p.m. Make sure to subscribe to the channel so you can get notifications when we release new episodes. We're here to help you retire the job and keep that paycheck. We'll talk soon.